Okay, let's unpack this. Imagine you're building a business, right? And you've chosen an S corporation for its unique tax advantages, a really popular choice for many people out there.
Definitely very common.
But what happens when you want to bring a valuable asset, say a piece of real estate or maybe some specialized equipment, into that S corp?
Or take something out, yeah.
Exactly. Or maybe you decide to sell your stake or, even wind the whole thing down. The tax rules around these property transactions and ownership changes, they can get, well, let's just say intricate.
Intricate is a good word for it.
So we're here today to try and cut through some of that complexity, maybe turn those tangled wires into a clearer path.
Yeah, and what's really fascinating here is how seemingly straightforward actions, like, okay, contributing a building or just taking a distribution, can have these significant and honestly often surprising tax consequences.
For both sides, right?
Yeah.
The company and the shareholder.
For both the S corporation and you, the shareholder. So our mission today really is to eliminate those pathways. We're going to focus intently on how gains and losses are realized, how they're recognized, and crucially, what all that means for your basis.
Basis. That word again. It's like your personal tax scorecard for your investment in the S Corp, isn't it?
That's a great way to put it. Exactly. Your tax scorecard.
Okay. So today we're embarking on a deep dive, looking at 4 core areas. These are pretty vital for any S Corp owner to get their head around. First, we'll explore what happens when you contribute non-cash property, stuff that isn't cash, to an S corporation. How is your gain or loss calculated as the shareholder? And importantly, what's the S corporation's new tax basis in that property? That's kind of your entry point.
Right. The starting point. Then we'll shift gears a bit. We'll delve into the implications if an S corporation makes a non-liquidating distribution of non-cash property.
Okay, so that means it hands out assets, but it isn't actually shutting down.
Exactly. What are the tax implications there? Again, for both the corporation itself and for you, the shareholder.
Got it. And after that, we'll tackle the grand finale, maybe. A full liquidation of an S corporation.
When the company closes its doors for good.
Yeah. How are gains and losses figured then for both the entity and the shareholders? And how do you figure out the basis of the property you actually receive when the company winds down?
Crucial questions at the end stage. And finally, we'll wrap up by tackling a really key aspect of S Corp operations, especially if you're navigating ownership changes.
Okay.
How is the S corporation's income or loss precisely allocated for tax purposes after a shareholder sells their ownership interest? This determines who pays tax on what and when. Very important.
Absolutely. And throughout this whole deep dive, we'll be zeroing in on those nuances, the little details that can lead to significant tax benefits, or, just as importantly, help you avoid some painful pitfalls.
Right. The goal is strategic information.
Our goal is to make sure you're not just informed, but strategically informed about these critical S Corp transactions. So let's kick things off right at the very beginning, bringing assets into an S corporation. So let's start right at that foundational level. Imagine you've got this great business idea, you're forming a new S Corp, and you want to contribute, say, a piece of real estate you own or maybe some valuable machinery into this new entity. And you get stock back in exchange.
The common scenario.
What are the immediate tax implications for you, the shareholder, like right out of the gate? And then how does the S corporation figure out its own tax basis in that property you just gave it?
Okay, this takes us straight to a cornerstone tax rule. It's often called Internal Revenue Code, Section 3501. You can kind of think of it as the tax-free handshake for setting up new businesses.
Tax-free handshake, I like that.
Yeah, because in essence, this section gives you a really significant tax benefit. It generally allows for the non-recognition of gain or loss when you transfer property to a corporation in exchange for stock. But, and this is key, there's a crucial condition.
Always a condition.
Always. The transfers, that means you and anyone else contributing property at the same time, must collectively control the corporation immediately after the exchange.
Okay, control.
Yeah.
What exactly does the IRS mean by control here? Is it just like owning more than 50%?
It's actually more specific than that. For Section 351 purposes, control means owning at least 80% of the total combined voting power of all classes of stock entitled to vote, and at least 80% of the total number of shares of all other classes of stock.
Wow, okay, so 80% of voting and 80% of everything else. That's a high bar.
It is. But if you're the sole founder contributing your property for all the stock, you easily meet it, right? It's really designed to help businesses form and restructure without triggering an immediate tax hit, especially when the underlying economic ownership hasn't really changed that much.
That sounds like a huge benefit then. So if I transfer my building, let's say I bought it for $100,000, but it's worth $500,000 now to my new S Corp, and I own all the stock right after. Generally, I don't have to worry about a $400,000 tax bill hitting me right away, even though I technically swapped an appreciated asset for something new, the stock.
That's precisely the general rule under Section 351. And you've hit on a really critical distinction there between realized gain and recognized gain.
Oh, okay. Tell me more.
You realize that gain or loss in that scenario, there's a theoretical profit, right? Because the fair market value, the FMV, of the stock you got is higher than your adjusted basis in the property you put in.
And FMV is just what it would sell for on the open market.
Essentially, yes. The source defines it as the price at which the property would change hands between a buyer and a seller when both have reasonable knowledge of all the necessary facts and neither is being forced to buy or sell. So in your example, you've definitely realized that $400,000 gain.
Okay, so realized is the theoretical profit on paper, but recognized gain is what I actually have to pay tax on now.
Exactly. And under Section 351, if you meet those conditions primarily, the control test that recognize gain is generally zero.
That is a huge strategic advantage. It lets businesses form or restructure without needing a pile of cash up front just to pay the tax man.
Precisely. This non-recognition is a key tax benefit, almost like an accelerator for business growth. Think about it. If you've built up significant equity in a building, like in your example, without Section 351, just trying to bring that into your S Corp could trigger a massive immediate tax bill. It could stifle your expansion before you even start.
Yeah, that would kill a lot of startups.
It's basically the IRS saying, okay, we'll let you move your chess pieces around on the board without taxing every single move, as long as the game is still fundamentally on the same board.
Yeah.
However, and this is really crucial, there are exceptions. Critical exceptions that do trigger gain recognition.
Ah, the tripwires. Okay.
Understanding these is vital for good tax planning. You really want to avoid these unexpected pitfalls.
All right, let's walk through them. What's the first, maybe the most common way people accidentally trigger a recognized gain here?
The first, and yeah, it's pretty common, is receiving boot.
Boot, like something you wear.
No, not quite. In tax terms, boot is basically anything you receive in the exchange in addition to the corporation stock. So if you get cash back, or maybe some other property that isn't stock, that's boot.
Okay, so stock is fine, but anything else is boot.
Right. Think of it like trading in your old car. The new car you get, like the S Corp stock, that's the main part of the deal.
Yeah.
But if the dealer also throws in some cash, or maybe a gift certificate,
That extra stuff.
that extra stuff is your boot. And just like you might owe tax on that extra cash from the car dealer, you generally have to recognize gain on the boot you receive in a Section 351 transaction.
Up to the amount of gain you realized, right?
Exactly. Your recognized gain is the lesser of the boot received or the total gain you realized on the transfer. The source we looked at, Pope 544, talks about these partially non-taxable exchanges. Gain is recognized to the extent of the money plus the fair market value of any non-like-kind property received. So it's not an all-or-nothing thing. If you pull cash or other non-stock assets out, you pay tax, but only on that portion.
That makes sense. You can't just pull cash out tax-free in that same transaction.
Huh.
Okay, what about liabilities? Lots of assets come with debt attached, like a mortgage on that building. How does the S Corp taking over my mortgage affect things?
That's an excellent question. And the general rule here is another really significant benefit for business owners. Usually, if the corporation assumes the shareholder's liabilities as part of the exchange takes over that mortgage payment, it is not treated as boot. It's not considered money or other property received by you.
Oh, wow. So I can transfer the building and its mortgage generally without triggering tax?
Generally, yes. That's a crucial benefit for transferring encumbered property. It makes incorporating assets with debt much easier. However,
Here come the exceptions again.
you know it. There are two critical exceptions here, and they are major pitfalls if you ignore them.
All right, lay 'em on us. I'm guessing one has to do with how much debt there is.
You guessed right. The first big one is if the total liabilities the corporation assumes are more than your adjusted basis in the total property you transferred.
Okay, so if the debt is bigger than my tax investment in the asset.
Precisely. In that specific case, gain is recognized, but only on the difference the amount by which the liabilities exceed your basis. Let's use your building example again. Say your adjusted basis is $100,000, but it has a mortgage of $120,000 that the S Corp assumes.
Okay.
That $20,000 difference, $120K mortgage minus $100K basis, is recognized gain to you. Even though you didn't get cash, The IRS views it as you being relieved of debt beyond your actual tax investment, so that part gets taxed.
It prevents you from having, like, a negative basis,
Yeah.
effectively.
That's a good way to think about it. Now, importantly, this rule generally excludes certain liabilities, like routine trade accounts payable for a cash basis taxpayer that would give rise to a deduction when paid. Those usually don't trigger this gain recognition rule.
Okay, so mainly mortgages and larger debts compared to basis. What's the second liability exception?
The second one is a bit more subjective. It's basically a bad purpose rule. If the principal purpose of the liability assumption was to avoid federal income tax, or if there was simply no bona fide business purpose for the corporation assuming the debt,
Then it's treated like boot.
then the entire amount of that liability assumed is treated as boot, as if you received cash. This could trigger a much larger gain. Honestly, this is less common in standard business formations, but it's there to stop people from trying to, say, borrow against an asset right before contributing it just to pull cash out tax-free.
So it's not just about the math. The intent and the business reason matter, too.
Absolutely. The substance of the transaction is key.
Are there any other, maybe less common, tricky areas when contributing property?
Well, there's one related to contributing property of relatively small value. This is kind of an anti-abuse rule.
Okay.
If the property you transfer is considered of relatively small value compared to stock you already own or stock you're getting for services performed, and the main reason you're transferring this small piece of property is just to help other transfers qualify for the tax-free treatment under the 80% control rule.
So like gaming the system to meet the control test.
Exactly.
Right.
If that's the case, your specific transfer might not qualify for the non-recognition benefit. And relatively small value here has a specific definition. It's generally less than 10% of the fair market value of the stock and securities you already own or are going to receive for services.
Okay.
No.
A specific rule for a specific situation. What if the stock I receive isn't just plain old common stock? What if it's something fancier?
That brings us to something called non-qualified preferred stock. If the stock you receive is considered non-qualified preferred stock, think of stock that might be redeemable by the corporation within 20 years, or maybe its dividend rate is tied to interest rates or commodity prices, making it act more like debt,
Okay.
then that non-qualified preferred stock is treated as other property. Essentially, it's treated like boot.
So receiving that could trigger gain, just like receiving cash.
Potentially, yes. This rule prevents certain financial instruments that are really more like debt than true equity from sneaking into the tax-free exchange rules of Section 351. It's another way the tax code tries to ensure that only genuine equity for property swaps get the main benefit.
Okay, that makes sense. So assuming we navigate all these potential traps and the property is successfully contributed under Section 351, what's the S-corporation's basis in that property? This seems super important, right? It's going to dictate the S-corp's future depreciation deductions or its gain or loss if it ever sells the property.
Absolutely crucial. The S-corporation's basis in the property it receives is generally the same as the shareholder's adjusted basis in that property immediately before the transfer.
So it just carries over?
It's what we call a carryover basis. The S-corp essentially steps into the shareholder's tax shoes for that asset. However, this carryover basis is increased by any gain that the shareholder did recognize on the transfer.
Okay. So back to my building example. Basis of $100K, mortgage of $120K. I recognized $20 gain.
Right. So your basis was $100. The S-corp's starting basis would be your $100K plus the $20K you recognized, so $120,000.
Got it. The S-corp gets credit for the gain I already paid tax on.
Exactly. This carryover concept is fundamental. It ensures that the gain that was deferred under Section 351 isn't just magically wiped away. It's preserved within the corporation's basis in the asset.
And what about depreciation recapture? If I, as the shareholder, was depreciating that property for years before contributing it, does that potential tax liability just disappear? Or does it carry over too?
It absolutely carries over. That's another critical detail. If the property you contribute is depreciable like machinery or a building generally, no recapture income is triggered on the contribution itself. However, the S-corporation, as the new owner, essentially inherits that depreciation history.
Yeah.
It must take into account the depreciation you, the shareholder, previously deducted when the S-corp later sells or disposes of the property.
So that built-in recapture potential, that ordinary income waiting to happen, it just transfers over to the S-corp.
Effectively, yes. It's a deferral of that recapture income under Sections 1245 and 1250, not an elimination. the S-corp steps into your shoes for depreciation recapture purposes as well.
Wow. So the tax headache might not be immediate for me when I contribute it, but it's kind of like a ticking time bomb sitting inside the S corp for later. That's a huge thing to consider when deciding which assets to contribute.
It absolutely is. Strategic asset contribution is key.
Okay, so we've covered getting assets into the S corp pretty thoroughly, but what about the other direction? What if the S corp decides to distribute some property, maybe equipment it doesn't need anymore, or even some land out to a shareholder? And let's assume the company isn't shutting down. This is just a distribution during ongoing operations.
Right, a non-liquidating distribution.
How does this impact both the S corp itself and the shareholder receiving the property? This seems like where the S corp pass-through nature gets interesting.
It really does.
Hmm.
This is where the flow-through aspect of S-corporations really shines, but with a few crucial twists that often catch people by surprise. Unlike C corporations, S-corp generally don't pay income tax at the corporate level.
Right, it flows through.
Income, gains, losses, deductions, they all flow through to the shareholders who report them individually. However, when an S-corp distributes property, it can actually trigger a taxable event for the S-corp itself before anything flows through, and this is a key area for planning.
Wait, so even though it's just handing property over and not selling it to a third party, the S corp might have to recognize a gain. That feels a bit counterintuitive for a pass-through entity. Why is that?
It does feel counterintuitive, does it? But it's a deliberate rule designed to prevent shareholders from pulling appreciated assets out of the corporation tax-free. Think
Yeah.
about it. If you could just distribute appreciated property without consequence, you could avoid tax on that built-in gain entirely.
Ah, okay. Closing a loophole.
Exactly. This is governed by what tax pros often call the deemed sale rule, primarily found in Internal Revenue Code Section 311. The basic idea is that an S-corporation generally recognizes gain as if it sold the property to the shareholder in its fair market value, FMV, at the time of the distribution.
So the S corp pretends it sold the asset for what it's worth.
Pretty much. The S-corporation's recognized gain is calculated simply as the FMV of the property distributed minus the S-corporation's adjusted basis in that property.
Okay, let's put some numbers on that again. Say the S corp bought some equipment years ago for $10,000. It's fully depreciated maybe, so basis is low, maybe zero. And now it's worth $50,000 if the S corp distributes it to a shareholder.
Then the S-corp would have a deemed sale, and it would recognize a $50,000 gain, assuming zero basis.
A $50,000 gain just for distributing it.
That's right. And because it's an S-corporation, where does that gain go?
It flows through to the shareholders.
Exactly. That $50,000 gain then flows through, usually pro rata, to all the shareholders. It increases their stock basis, and it's taxable income to them at their individual tax rates. So the shareholders end up paying the tax on the gain triggered by the distribution.
Okay, so the S corp recognizes the gain, shareholders pay the tax. What about losses? What if that same equipment had gone down in value? Say basis was $10,000, but it's only worth $5,000 now. If the S corp distributes it, can it recognize a $5,000 loss to pass through?
This is a really critical point, and often a trap for the unwary. While appreciated property triggers gain for the S-corp, the tax code generally says an S-corporation is not allowed to recognize a loss on a non-liquidating distribution of lost property to a shareholder.
No loss recognition on distributions, really.
Generally, no. The IRS essentially says you can't just create a deductible loss by handing over a depreciated asset to your owner. So if an S-corp has property that's gone down in value and wants to recognize that loss,
It needs to sell it to someone else first.
that's usually the strategy. Sell the lost property to an unrelated third party, recognize the loss, which then flows through shareholders, and then maybe distribute the cash proceeds if needed. Distributing the lost property directly usually means the loss just disappears, at least at the corporate level.
Wow, that's a huge difference between how gains and losses are treated on these distributions. What about depreciation recapture? We talked about that coming in. Does it apply going out too?
Oh, absolutely. Depreciation recapture under Sections 1245 and 1250 is highly relevant here, just like with contributions. If the property being distributed is depreciable property,
Like that equipment.
right, the S-corporation will have ordinary income to the extent of any prior depreciation taken on that asset. This recapture income is limited by the total gain realized on the deemed sale.
And that ordinary income flows through too.
Yes, that ordinary income passes through to shareholders, just like any other type of S-Corp income. So in our $50,000 gain example, if, say, $30,000 of that gain was due to prior depreciation, the shareholders would report $30,000 of ordinary income and maybe $20,000 of capital gain, depending on the asset type.
Okay, so the S-Corp recognizes gain, but not loss. It flows through. Shareholders pay tax. Now let's flip to the shareholders' side. What are the tax implications for them when they actually receive this property? Is it just income equal to the value? Or does their stock basis, that personal scorecard, come into play again?
It definitely comes into play. For the shareholder, the starting point is that the amount of the distribution is simply the fair market value, FMV, of the property they received.
So $50,000 in our equipping example.
Right. Now, the taxability of that $50,000 distribution to the shareholder is governed by IRC Section 1368, and it depends very heavily on two critical accounts within the S corporation. Its Accumulated Adjustments Account, or AAA, and if it has any, its Accumulated Earnings and Profits, or AEP.
Ah, AAA and AEP. These can get notoriously complicated for business owners. Can you give us maybe a simplified way to think about them, like a metaphor?
Sure, let's try. Think of the Accumulated Adjustments Account, AAA, as like a special pot within the S Corp. This pot tracks the S corporation's undistributed taxable income that has already flowed through and been taxed to the shareholders over the years.
So it's money I've technically already paid tax on, just sitting in the company.
Essentially, yes. Or it could include certain tax-exempt income as well. The key is distributions from this AAA pot are generally received tax-free by the shareholder.
Okay, so distributions come out of AAA first, tax-free. But what happens when that pot is empty?
Good question. Once the AAA is exhausted, we look to see if the S corporation has any accumulated earnings and profits, AE&P. Now, think of AE&P as a legacy account. It typically only exists if the company used to be a C corporation before it elected S status.
Ah, profits from the C Corp days.
Exactly. Profits earned back then that were taxed at the corporate level but never distributed to shareholders. If distributions come out of this AUP pot, they are taxable to the shareholders as dividends.
Taxable again? Like a double tax?
Effectively, yes.
Yeah.
Similar to how C Corp dividends are taxed.
Yeah.
This is a really common trap for former C Corp that convert to S Corp without fully understanding these rules.
Okay, so first AAA, tax-free, then AE&P, taxable dividend. What if the distribution is even bigger than both of those accounts combined?
If distributions exceed both the AAA and any AE&P, they are then treated as a tax-free return of the shareholder's remaining stock basis. So it reduces your basis in your S Corp stock.
Reduces my scorecard value.
Right. And once your stock basis is reduced all the way down to zero, any additional distributions beyond that point are typically treated as capital gains, usually long-term capital gain if you've held the stock long enough.
Wow. Okay, so it's a distinct order. AAA first, tax-free, reduces basis, then AE&P, taxable dividend, no basis effect, then return of basis, tax-free, reduces basis to zero, then capital gain.
You nailed it. That's the hierarchy under Section 1368. And you can see why tracking your stock basis and the corporation's AAA balance is absolutely critical. It determines the tax character, how much is tax-free, how much is dividend, how much is capital gain for every single distribution.
Can we maybe walk through a quick example just to solidify that flow?
Sure. Let's say a shareholder has a stock basis of $10,000. The S Corp has a AAA balance of $15,000 and also happens to have $5,000 in AE&P from its prior C Corp life.
Okay, $10K basis, $15K AAA, $5K AE&P.
Now, the S Corp makes a non-liquidating distribution of property with a fair market value of $25,000 to this shareholder.
$25,000 distribution. How does it break down?
Okay, step one. We look at AAA. The first $15,000 of the distribution comes from the AAA. This $15,000 is tax-free to the shareholder.
Tax-free. Does it affect basis?
Yes. Tax-free distributions from AAA do reduce basis. So the shareholder's $10,000 basis is reduced. Since the distribution $15K is more than the basis, $10, the basis goes down to $0. The AAA account also goes down to $0.
Okay, basis is zero now. What about the next part of the $25K distribution?
Right, we still have $10,000 of the distribution to account for. $25K total, $15K from AAA. Step two, we look at AE&P. The S Corp has $5,000 of AE&P. So the next $5,000 of the distribution comes from AE&P.
And that's taxable.
That $5,000 portion is taxable to the shareholder as a dividend. It does not affect their stock basis, which is already zero anyway, but it does use up the $5,000 AE&P balance.
Okay, so $15K tax-free reducing basis, $5 taxable dividend. We've accounted for $20K. There's still $5K left of the $25K distribution.
Exactly. Step three, we've exhausted AAA and AE&P. The remaining $5,000, $25K total, $15K AAA, $5 AE&P is considered a distribution beyond basis, since the shareholder's basis is already $0.
Capital gain.
That entire $5,000 is treated as a capital gain for the shareholder.
That example really clarifies the tiers and how basis interacts. Super helpful. One last thing on this. What's the shareholder's basis in the actual property they received? In that $25,000 worth of property?
Good question. The shareholder's basis in the distributed property is its fair market value, FMV, at the time of the distribution.
So $25,000 in our example.
Yes. It's what we call a stepped up, or sometimes stepped down if the value decreased basis. It reflects the property's current market value right when the shareholder receives it, regardless of what the S corporation's old basis was. This is really important for their future tax calculations if they later sell that property or decide to depreciate it themselves.
So they get a fresh start basis at fair market value.
Got it.
Okay, we've navigated assets coming in and assets going out during regular operations, but what about the end game? When an S corporation decides, that's it, we're closing up shop, and distributes all its remaining assets to its shareholders.
The complete liquidation.
Yeah. This isn't just another distribution, it's the final act. I imagine the tax rules here are pretty comprehensive, maybe different from the non-liquidating ones.
They are definitely comprehensive, and yes, there are some key differences because the corporation is actually ceasing to exist as a separate legal and tax entity. The whole goal here is to figure out the final tax picture, settle all the accounts, basically for both the S corporation and its shareholders as the entity dissolves.
So let's start with the S corp itself again. We learned that in a non-liquidating distribution, it recognizes gain on appreciated property, but generally not loss. Is it the same when liquidating?
Here's a major difference. In complete liquidation, the S corporation generally recognizes both gain and loss on the distribution of property.
Both gain and loss. Okay.
Yes. Under IRC Section 336, the rule is that the S corp recognizes gain or loss as if it had sold all its property at fair market value, FMV, right at the time of the distribution.
So it calculates the gain or loss on each asset, FMV minus basis.
Exactly. For every asset distributed. So if the S corp had that building with a basis of $200,000 that's now worth $500,000, it recognizes a $300,000 gain. But if it also had that piece of land with a basis of $100,000 that's only worth $60,000 now,
it recognizes the $40,000 loss.
In a complete liquidation, yes, it generally recognizes that $40,000 loss. Unlike the non-liquidating scenario where that loss might be disallowed, here, because the entity is truly winding up, both gains and losses are typically recognized at the corporate level.
That makes sense conceptually. It's the final accounting.
Precisely. And just like before, any recognized gain or loss at the S corp level flows through to the shareholders.
And adjusts their stock basis one last time.
Right. Gains increase basis, losses decrease basis right before the shareholders calculate their own consequences from the liquidation.
And depreciation recapture, does that still get triggered in this final distribution?
Oh, yes. Any potential depreciation recapture under Sections 1245 and 1250 is fully recognized by the S corporation as ordinary income upon the liquidating distribution. That ordinary income flows through to the shareholders as well as part of that final pass-through. It's the last chance to account for those prior deductions.
Okay. And you mentioned holding period earlier.
Yes. The source noted that for property received by a shareholder in a liquidation where gain or loss is recognized, the shareholder's holding period for that property generally starts the day after they receive it. That's a detail relevant for their future tax planning if they hold on to the asset.
Good detail. Okay, so the S corp figures out its final gains and losses, including recapture, and all of that flows through to the shareholders, adjusting their basis one last time. Now let's focus on the shareholders. How do they treat receiving all this property in the liquidation? Is it still that complicated AAA, AE&P waterfall we talked about?
Actually, no. That's another key difference in a complete liquidation. For the shareholders, receiving property in a complete liquidation is generally treated as if they sold or exchanged their S corporation stock.
Okay. So it's not treated like a regular distribution, it's treated like a sale of their shares.
Exactly. Think of it as selling your shares back to the corporation in exchange for your share of the corporation's net assets, the property received.
So the calculation for the shareholder is different then. It's not about the company's AAA or AE&P balances.
Correct. The shareholder's gain or loss calculation is much more straightforward in liquidation. They compare the fair market value, FMV, of all the property they received.
Minus any liabilities they assumed with that property.
Good point, yes. FMV of property received, minus any corporate liabilities the shareholder assumes related to that property. They compare that net amount to their final adjusted basis in their S corporation stock, after accounting for that last flow-through of corporate gain loss.
So basically, what I got out minus my final stock basis.
That's the essence of it. It's measuring the gain or loss on their entire investment in the S corporation.
And is that gain or loss usually capital gain or loss?
Yes, typically it's a capital gain or loss for the shareholder, because stock is usually a capital asset. Whether it's short-term or long-term depends on how long they held their S corporation stock.
So if I held my stock for more than a year, usually long-term capital gain, which often gets better tax rates.
Generally, yes. Our source material, Pub 544, although using a non-S Corp example, really highlights this core principle for any sale or exchange. Gain or loss is the amount realized, like the FMV of assets received, minus the adjusted basis. That's the fundamental calculation shareholders use in a liquidation.
Okay. And one last piece for liquidation. What's the shareholder's basis in the actual property they receive, like the building or land they get when the company dissolves?
Similar to non-liquidating distributions, the shareholder's basis in the property received in a liquidating distribution is generally its fair market value, FMV, at the time of the distribution.
So again, a fresh start basis at market value?
Yes. This ensures that the property's basis reflects its actual value at the moment it transitions from the defunct corporation into the shareholders' hands. It sets the stage accurately for their future tax consequences related to that specific property.
All right, let's shift gears one last time. S corporations, as we said, are all about pass-through. So let's tackle a really common situation. A shareholder sells their interest mid-year. Maybe they're retiring, maybe a new partner is buying in. How does the S-Corp's income or loss for that entire year get, sliced up between the person who sold and the person who bought? It can't be as simple as just splitting the year in half, can it?
No, definitely not that simple. And this is a critically important area because the allocation method used directly impacts each shareholder's tax liability for the year. It also affects their final stock basis adjustment.
Right, basis again.
It's always basis. The IRS actually provides two main methods for allocating S corporation income and loss when there's a change in shareholder ownership during the year. The default method, called the per share per day method, and an elective method, the closing of the books method. The choice between them can have pretty significant financial results.
Okay, before we dig into those two methods, can you just quickly remind us again why stock basis adjustments are so incredibly vital in S Corp? It feels like that's come up in literally every segment we've discussed.
It really has, and for good reason. Think of that shareholder stock basis again, your personal tax scorecard for your S Corp investment. It's constantly being adjusted up and down for the S Corp's income, losses, deductions, and distributions that flow through to you. This is all governed by Section 1357 of the Tax Code.
And why does that scorecard matter so much?
Well, it directly impacts several really key things for you as a shareholder. First, it limits your ability to deduct losses. You generally can't deduct S Corp losses that are more than your combined stock and debt basis. Any excess loss gets suspended and carried forward.
Okay, loss limitation. What else?
Second, it determines the taxability of distributions, as we saw with the Trade Play AMP rules. You need basis to receive distributions tax-free.
Right.
And third, it determines your gain or loss when you ultimately sell your stock or when the corporation liquidates. So yeah, tracking basis accurately is the absolute backbone of your S Corp tax situation.
Okay, so what kinds of things make that basis scorecard go up? What increases basis?
Basis generally increases with the taxable income that flows through to you from the S Corp. But also, importantly, it increases with certain types of tax-exempt income.
Tax-exempt income increases basis, like what?
A really interesting example that came up in our source material involves life insurance proceeds. Let's say your S corporation owns a policy on a key employee or shareholder, and it's the beneficiary. If that person passes away, the death benefit the S corp receives is typically tax-exempt income.
Okay.
That tax-exempt income flows through to the shareholders and increases their stock basis.
Wow. So if the S Corp gets a big life insurance payout, that could significantly boost my basis, making future distributions potentially tax-free or reducing my gain if I sell my stock later. That seems like a powerful, maybe unexpected benefit?
It absolutely can be. The source material even pointed out a potential double stock basis benefit for life insurance owned by an S corporation because that tax-exempt income bumps up basis. The timing of when that basis increase happens depends on whether the S-corp is cash or accrual basis, which could affect which shareholders get the basis bump if there's an ownership change around that time.
Interesting timing issue. What else increases basis?
Another item, if it's includable in the S-corp's income, is cancellation of debt, or e.g. income. If your S-corp has debt forgiven by a lender, and that forgiveness counts as taxable income, that income flows through and increases your basis too.
Okay, so income items, taxable or tax-exempt, generally increase basis. What about the flip side? What makes basis go down?
Basis decreases with deductible losses and expenses that flow through to you from the S-corp. It also decreases for distributions that aren't dividends, like those AAA or return of basis distributions we talked about. And, importantly, it decreases for certain non-deductible expenses.
Non-deductible expenses reduce basis. Like what?
Well, sticking with the life insurance theme, if an S-corp pays the premiums on that policy, where it's the beneficiary, those premium payments are generally non-deductible expenses for the S-corp.
Okay, so those reduce my basis.
Yes. But there's a crucial nuance here, especially if it's a policy that builds cash value, like a whole life policy. The basis reduction isn't necessarily for the full premium paid.
Oh, how does that work?
If the policy's cash surrender value, the savings component that builds up increases during the year, only the portion of the premium that exceeds that cash value increase reduces the shareholder's stock basis. Essentially, only the part of the premium paying for the pure insurance cost, the death benefit protection, reduces basis. The part that's just increasing the policy's savings value doesn't.
Can you give us a quick example of that? That sounds subtle but potentially important.
Sure. Let's say your S-corp pays an $8,000 premium this year for a whole life insurance policy. That $8,000 is non-deductible to the S-corp. But let's say during that same year, the policy's cash surrender value goes up by $3,000.
Okay.
In that case, your stock basis is not reduced by the full $8,000 premium. It's only reduced by the difference. $8,000 premium minus the $3,000 cash value increase. So only a $5,000 reduction to your basis.
So the basis reduction is only the net cost of the insurance coverage itself.
Exactly. It's a subtle but important detail. It means your basis stays higher than if the full non-deductible premium hit it, which is generally better for you tax-wise down the road. It requires careful tracking, though.
Definitely sounds like it. What about those tax credit bonds you mentioned? How do they fit into basis? Seems like a niche area.
It is a bit niche, but worth a quick mention. Congress has created various types of bonds that provide tax credits. The way these interact with S-corp basis can be complex, but the general theme is often to prevent an artificial inflation of basis.
How so?
Well, for many types, even if the credit amount is treated as some kind of deemed interest income flowing to the S-corp, the law might specifically disallow a corresponding basis increase for that deemed income. The goal is usually to make these bonds basis neutral for shareholders, preventing the credit from giving you an extra basis boost beyond your economic investment.
So no double dipping, essentially.
That's the idea. The source material did have some examples showing how these rules could interact with S-corp losses, potentially affecting how much loss you can deduct currently versus how much gets suspended. But it's fairly specific to situations where an S-corp holds these types of bonds and also has losses.
Okay, interesting nuance. Let's get back to our main topic for this segment then. Allocating the S-corp's income or loss when a shareholder sells their shares mid-year. You said there are two methods. What's the default one, the one that applies if you don't choose otherwise?
The default method, and the one that's used unless a specific election is made, is the per share per day method.
Per share per day. Sounds descriptive. How does it work?
It works exactly like it sounds. First, you determine the S-corporation's total income or loss for the entire tax year. Then you divide that total amount by the number of days in the tax year, usually 365, to get an average daily amount of income or loss.
Okay, an average amount per day for the whole year.
Right. Then for each shareholder, you allocate a pro rata share of that daily amount based on the number of shares they owned on that specific day, multiplied by the number of days they held the stock during the year.
So if I sell my shares exactly halfway through the year, say on July 1st, I still get allocated income or loss based on the average daily amount for the entire year, just multiplied by the 182 or so days I own the stock.
Precisely. You will be allocated a portion of the entire year's income or loss, prorated for the number of days you were a shareholder.
So that means the buyer who comes in on July 1st might get allocated income or loss that technically happened before they owned the shares, and I might get allocated stuff that happened after I sold.
That's the implication. It's effectively averaging the S-corp's activity over the entire year and spreading it evenly across all the days and shares. So, for example, if the S-Corp had a huge unexpected income event occur in December, long after you sold your shares in July.
I'd still get allocated a portion of that December income.
Under the per share per day method, yes, because it looks at the whole year's total and averages it out.
That could be really good or really bad, depending on when the income or losses actually occurred relative to the sale. Seems kind of imprecise.
It can be. It's simpler administratively, perhaps, but it might not reflect the economic reality very well if income or losses are lumpy during the year. If there's a big surge in income right after you sell, you might end up paying tax on profits you never really benefited from. Or if there's a big loss right before the buyer came in, they might get the benefit of a loss that happened before their time.
So what's the alternative? The one that offers more precision?
The alternative is the closing of the books method,
Right.
and this one requires an affirmative election.
Closing of the books, how does that work?
This method basically treats the S corporation's tax year as if it were two separate, shorter tax years for allocation purposes. One ending on the date the shareholder terminates their interest, and the second one starting the next day.
So you actually cut the year in two.
For allocation purposes, yes.
Yeah.
The S corporation effectively closes its books as of the end of the day of the sale or other terminating event. It calculates its actual income and loss items up to that specific date.
And allocates that amount just to the shareholders who own stock during that first part of the year.
Exactly. The income and loss from the first short period are allocated only to the shareholders who held stock during that period, using the per share per day method just within that shorter period. Then, the income and loss items generated after the sale date in the second short period are allocated only to the shareholders who held stock during that second period.
Ah, that sounds much more precise. It connects the income or loss directly to the period it was actually earned or incurred.
It absolutely does. It provides a much more accurate reflection of the economics during each ownership period.
When is this method typically used? And why would someone choose it over the default? Does the departing shareholder have to completely sell out?
Yes, this election is generally available when a shareholder completely terminates their entire interest in the S corporation during the year, whether by sale, redemption, death, etc. It's often preferred and agreed upon by the buyer and seller, precisely when there is a significant or unusual income or loss event expected to happen around the date of the sale.
So if we know the company is selling a huge asset right after I leave, I definitely want the closing of the books election.
You likely would, yes.
Yeah.
That way, the gain from that asset sale, which happens after you've left, would be allocated entirely to the remaining or incoming shareholders in the second period. You'd be insulated from the tax consequences of events occurring after your departure. It creates a much cleaner break.
So the choice between these two methods, the default per share per day or the elective closing of the books, can really impact the bottom line tax bill for both the seller and the buyer. Sounds like something that should definitely be discussed and agreed upon as part of the sale negotiation itself.
Absolutely critical. The decision can significantly swing the tax liability and the final basis adjustments for both parties. It's a key negotiation point in many S corporation interest sales, allowing for a more precise and often fairer allocation of income and loss that aligns tax consequences more closely with the economic reality of who owned the company when things actually happened. Hashtag outro pink.
So after all that, what does this all really mean for you if you're an S corporation owner or thinking about becoming one? We've journeyed through some pretty intricate territory today: S Corp property contributions, those non-liquidating and liquidating distributions, and finally, how income gets allocated when ownership changes. It seems abundantly clear that these aren't just lines on a tax form, right? They're dynamic situations with real, often significant financial impact on your business and ultimately on your personal wealth.
Indeed. And the ability to correctly calculate those gains, losses, and especially basis that crucial tax scorecard we keep mentioning, and to truly understand the flow-through implications, that can honestly be the fundamental difference between a smooth, tax-efficient transaction and getting hit with an unexpected and potentially costly tax bill down the road.
Yeah, that critical thinking, understanding the why behind the rules seems essential, especially with so much information out there. Knowing these specifics really empowers you to approach your S-Corp's financial decisions with greater clarity and maybe more strategic foresight.
Couldn't agree more. Clarity and foresight are key.
We saw how contributing non-cash property, that Section 351 handshake, generally lets you defer gain, which is a huge benefit for getting started. But you've got to watch out for those exceptions, like receiving boot or having liabilities exceed your basis. Those are real tripwires.
Definitely. And then we uncovered how non-liquidating distributions trigger that deemed sale for the S-corp itself, passing gain, but usually not loss, through to the shareholders. And for the shareholder receiving it, the tax impact hinges on carefully tracking the AAA and any leftover AEMP from prior C-corp years.
Right, that waterfall matters. And then in the final act, liquidation, we learned that both the S-corp and the shareholders generally recognize gain or loss, often treating it like a sale of stock for the shareholders, usually resulting in capital gains or losses. And the priority they receive gets that fresh start, fair market value basis.
A complete reset at the end. And finally, we explored those two methods per share per day versus closing of the books for allocating income and loss when a shareholder sells their stake, highlighting again just how vital meticulous stock basis tracking is through every single one of these transactions.
Absolutely. Each area has its own complex rules, its own potential pitfalls, but also, as we've seen, some significant opportunities for tax efficiency and smart strategic planning.
So maybe a final thought for you, our curious listener, to mull over. If we've seen how a single major tax event, like selling a big asset or taking a significant distribution or even receiving life insurance proceeds can fundamentally alter a shareholder's basis, that personal tax scorecard, how might proactive, year-round tax planning, rather than just scrambling at year-end, become perhaps the most powerful tax benefit of all for S-corporation owners?
That's a great question to ponder. It really emphasizes being proactive. We strongly encourage you, if any of this applies to you, to review your own S-corp structures and any planned transactions with a qualified tax professional. Get advice tailored to your specific situation.
Definitely seek professional advice.
Because knowledge really is power, and in the often complex world of S-corp taxation, it truly pays to be informed.